What's up, everybody? Michael Silva here to do some technical analysis on the NDX, the Nasdaq 100. This is an update video to my previous video, which the link will be in the description, or I'll put the link up right over here. That is where I went into the monthly time frame, the weekly time frame, and then the daily time frame. That last video was published just about a month ago, and I feel like it's necessary to do a follow-up. Let's get into it. All right, welcome back. So we're going to go into the monthly time frame first, then we're going to go into the weekly time frame and then the daily time frame. I'm going to kind of follow up a little bit on what we discussed on the previous video. So if you haven't watched it, that's fine. If you want to go back and watch it, be my guest. The link is in the description. First thing that I want to do is from the monthly time frame, point out this candle. That candle was the one that we were discussing on the previous video. And we were saying that it was getting overextended by the Bollinger Bands. So if you're unfamiliar with the Bollinger Bands it's a good indicator to know when something is basically just overextended in one particular way. And when it gets overextended, you can sometimes see a pullback. Now these overextensions, they can last for a period of time. And that's what we had talked about previously. Now notice this candle here, it got overextended. The wick kind of really went up. And then we had that pullback from a high of 97.01 all the way down to 67.97, so a significant pullback there. And what we're seeing here is a pretty significant run up these last 4 months straight due to the increased liquidity in the markets from the Federal Reserve. Now on this candle here, it was overextended and we notified, hey, it still has potential to swing up to the upside, and our price target was 11,000 to 12,000, and I still have that as the price target. It did get as high as 11,071, so we're pretty spot on there. And now it is currently July 27th, so we don't have too many more trading days left in the month. But when we get into the daily time frame, there is a bit of a warning sign kind of flashing red, and that is the very important piece that I want everybody to take note of. Now keep in mind, this week is going to be very choppy. We have earnings week and we have some big tech stocks coming out with earnings, so be very aware of what's taking place. Don't just put on trades because you have a good feeling that something might happen. No, if you're unfamiliar with how to trade during earnings season, I highly recommend just watching what's going on from the sidelines until you get a better idea as to how to manage your money and manage your trades in these type of environments. Okay, so as I said, it's July 27th. We had a high of $11,071. And now really, this is the only thing that I want to point out. So it's creating somewhat of a nice upper wick. So this is going to look very bearish if the price continues to move down. So that is one level that I want to keep an eye on heading into next month. If this candle could come all the way down, if the price can reach down here to 10,166 and close below it, that would be one very, very nasty looking reversal candle. And I would expect more of a pullback to take place if we close below that level. However, as of right now, it is above a very specific trend line that we're now going to talk about on the weekly time frame. All right, so we are here on the weekly time frame, and you're looking back all the way to about 2010 here. And why I pulled this up is because I wanted to show you this trend line and how the price action is currently acting within this trend line. Now, this is a very long-term trend line, so I know that there's a lot of people, a lot of traders, a lot of algorithms that are keeping an eye on this specific level. We recently talked about many negative divergences that were taking place on the RSI. As you can see, we had a low high here and then a higher high here on the price action, but yet on the RSI you can see that it was putting in a high here and then a lower high here, creating a negative divergence, which ultimately leads to some sort of a pullback. Now, as the current price action is forming, you can see something very similar taking place. As you can see, the price action from here to here, it is putting in a higher high. And then from here on the RSI to here on the RSI, it is putting in a lower high, which is a negative divergence. These sometimes can result in pullbacks, so it's worth noting. That doesn't necessarily mean that it's just going to be some sort of flash crash. That's possible, but it's just worth noting and being prepared for, because a move like this in overextended territory above this trend line, does look like a spot where you wouldn't necessarily want to go long as of right now. This is, to me, a buy the dip, sell the rip type of market. And once we get into the daily time frame, you're going to really notice a pretty nasty pattern that's been setting up since March. So once again, this is the weekly time frame, and I wanted to point out these candles that were forming right here, right above this 10-year trend line. See, we had a nice big shot up above it, but then this candle, the two middle candles really right here and then right here, these ones are pretty bearish. And the reason why I say that is because, one, it's just a very red candle here, and then you have a long upper wick on this candle. Now you might be saying, well, this green candle looks like it's bouncing just fine. Well, today's Monday, so this is not a lot of data for a weekly candle. There's still a lot more trading days left for this candle to finish. So as far as what would make this look a little bit more bearish to me is to see the price close below last week. If the price closes below last week, which is 10,314, maybe just a little bit lower than that, that would signal to me that the price can continue on to the next week to the downwards direction. Earnings are coming out, so play with caution these type of trades, especially shorting into what the Fed has been doing to stimulate the economy. They have the 2-day Fed meeting wrapping up here on Wednesday. So this is really just not the type of market at this particular point in time that I feel comfortable shorting, even though that there's still a lot of red flags popping up. Let's go ahead and hop into the daily time frame so I can show you the big 3-month bearish pattern that is formed and recently just broke down from. All right, so we are looking at the NDX, the Nasdaq 100 index on the daily time frame. And as you can see from the March lows, what a just rip up to the upside, creating all-time record highs and just continuing to move higher and higher. Now, we stated on the monthly time frame what looked a little bit iffy. We stated on the weekly time frame what looked a little bit iffy. And now on the daily time frame, I also want to point out something that is pretty darn iffy. Now, if you're thinking right now, hey, this guy's super bearish bias, that is not true. I am looking at both sides, the bullish side of things and also the bearish side of things. I'm covering some of these warning signs because, one, they're extremely important, especially to new investors that think right now is the best time to start investing. Now, obviously, we're living in times where the Federal Reserve is doing something that has never happened before. Unlimited liquidity into the markets, unlimited QE. There's a million different names for it. We have the COVID-19 still around with the second wave. So there's a lot of things taking place, a lot of different stimulus packages that might send this market to an all-time high and just continue to melt up. But I still need to point out these bearish signs because it can potentially save you from buying at the wrong time where you could potentially buy at a better time. Now, the pattern that I'm seeing form that just recently broke is this right here. This is what's known as a rising wedge pattern. And as you can see, this rising wedge is basically saying that, hey, the market goes higher and higher and it gets tighter and tighter as it coils up, and eventually it breaks down to the downside. And this is why I really wanted to make this video, was to point out the break of this rising wedge. So here on this day was a pretty bearish day on July 23rd. The market pulled all the way down, then gapped down the next day on the 24th, and then moved lower into the 10-year trend line. So this 10-year trend line on the weekly time frame, I have it up here still, it actually bounced and acted as support. So this is why I'm saying it's one of those buy the dip, sell the rip type of markets. And then today, obviously, we had a nice big rally as well. What can happen here? Well, what could very well happen is this right here. Once resistance is broken, it then becomes support. Now, this is a 10-year resistance. So to think that this won't get tested again could be a little bit ignorant. So we had this breakout of this rising wedge. It bounced from here and pulled up. So what can potentially happen? Well, we might see a move to the upper high. Like I said, it's earnings week, so we can see some choppy movement. But ultimately, this type of pattern would suggest we're going to see a break of this 10-year trend line back to the downside, and we could potentially see this rising wedge come all the way down to its next major area of support. What is the major area of support? Well, in order to check out major areas of support, let's go ahead and pull up the Fibonacci retracement level. So looking at this Fibonacci retracement level, it would be ideal that the first point to look at is going to be about 10,150, maybe just a little bit lower if you just keep an eye on these technical levels that acted as resistance previously. But if we're going with the Fibonacci extension, 10,151 would be the 78% retracement level. So if we do get a crack below this 10-year trend line that we mapped out on the weekly, I think the next level would be that 10,000. And then from that point, if we had a close below that, we can even head lower to the 61% retracement level. Now, a drop from a high of 11,000 down to 94.29, that's a pretty significant move in the markets. And this index really has been leading the way in all other markets. So if the Nasdaq 100 was to fall at those type of levels, that would be considered a market correction and just about entering into a bear market. A 20% drop on one of these indexes would be considered a bear market. This type of drop down to that 61% retracement level, it would be 15% down. So we would need to see it really come down to this 50% retracement level, just a little bit more, in order to technically call it back into a bear market. And if we do see that dramatic to the downside, is the Federal Reserve going to let that happen? I don't think so. I think that they're here to supply the markets with as much liquidity as necessary to basically keep this bubble going. One rule of thumb that I always like to take note of is how far can a rising wedge pattern actually fall? Well, in order for me to do that, I like looking at the base of the rising wedge to determine, as a rule of thumb, this is not necessary, of how far the drop could be. So if I were to do that, it would be about a 2,100 point swing. So looking at that, and if I were to come over here, from the break to that point, we would be looking at a pullback to about 8,600. That'd be a significant drop. That would be considered a bear market in the Nasdaq 100. All right, that is all I have for you on the Nasdaq 100 technical analysis review. If you guys have any questions, comments, concerns, leave them in the comments section below, and I'll get back to them as soon as I can. See ya later.